we outline those. We're very upfront about it. People ask us what the greatest risk of the investment is specifically. We always identify it.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we are joined by Ashley Wilson. Ashley is the co-founder of Bar Down Investments and HouseItLook. She's also the co-host of the Passive Investing podcast and a best-selling author of The Only Woman in the Room, Knowledge and Inspiration from 20 Women Real Estate Investors. And she's also a BiggerPockets series host. Ashley started investing in real estate in 2009 and has been involved in over 100 million in transactions within both single and multifamily real estate across over 1,500 units. In 2022, Ashley was a ConnectCRE Award Recipient. And when she's not working on her businesses, she enjoys spending time with her husband and their 2 daughters, and also enjoys competing with her horses. Ashley, welcome to the show.
Thank you so much for having me.
Yeah, so great to have you on board. It's just been such a pleasure getting to know you over the past couple of years. And I can't believe it's so long that we've actually, haven't had a chance to do this. So really appreciate your time today, and, looking forward to getting into some, conversation with you as well.
Likewise.
So why don't we start off and, just tell the audience a bit about your background and how you got into real estate. And I know it's a really interesting story from your side and the transition from corporate America. So how did it all start for you?
Exactly, Dave. I actually started in corporate America, as you mentioned, in clinical research and development for pharmaceutical companies. So I worked for Sanofi Aventis, Wyeth, which is now Pfizer, and GlaxoSmithKline. And during my tenure in pharmaceuticals, I invested on the side in real estate. I wouldn't call it passively. I wouldn't call it actively. It was kind of like a hybrid. I had a very tight bandwidth with everything that I was doing in pharma. So everything I did with real estate was trying to make it as automated as possible. I started with house hacking, short-term rentals, long-term rentals. Eventually, I started a flipping business where we focused on high-end older homes that I partnered with my father. And he's a general contractor. He's had his own business for over 45 years. So it was a natural fit. And then in 2018, I transitioned to commercial real estate and started focusing on large multifamily properties, specifically repositioning of them. With my background with construction and operational management, it was a perfect marriage to combine asset and construction management, leverage that skill set, and partner with other people originally to get my foot in the door. And then eventually I launched Bar Down Investments, which is a company that I own today with my partner, Jay Scott.
Excellent. And was there some type of, compelling event or something that was really leading you into real estate from the corporate world?
My husband and I both were making a decent salary when we first started working, and we aren't firm believers in the stock market for multiple reasons. One is because we don't like speculative investing. Number 2 is we don't like non-asset backed investments. Number 3 is we don't like investments that don't have tax advantages. And number 4, we are firm believers in leverage, and the stock market, mostly the traditional way of investing in the stock market, has a very limited ability to leverage. So with real estate, that solves all of those things that we don't like about the traditional stock market investing strategy that most people do in corporate. And we got turned on to real estate in 2007. That's when we found BiggerPockets and started listening to their podcast for 2 years before we pulled the trigger in 2009.
Great. And what do you think really from an active versus passive role? I mean, did that, come into your thought process and everything, which is, can we just be an investor or do we really want to go the active route? What were you really thinking there?
What's interesting is most people consider me an active investor, but I probably have more investments or as equal investments in passive real estate investment opportunities that I have in my active investments because once again, it's a bandwidth issue. And it's also, I'm a firm believer in diversifying your asset portfolio because I think that gives you the most advantageous way in which you can grow your wealth. Not every single asset performs the same depending on the different market cycles. So, in order to hedge your bet, so to speak, I think it's best to diversify. When we first got started, we didn't know about the passive investment opportunities. And because we are a little bit of control freaks, we chose the traditional, more active path that I think most people think of when they get in real estate. They think of wholesaling and flipping as really the gateway into investing in real estate. And we were no different from that. So we started with that. And while we have continued actively investing, we continue to increase our passive investments every single year. And I think when you look at your overall lifespan, there are different times in your life where active versus passive is more suited for what you can and want to do during that part of your life. So I will not always be an active investor. I'm guessing that there will be a point in my life where I transition, to a more passive role. But today I love real estate. I know not everyone loves real estate, but I actually do love real estate. I love what we're doing. So for me, active is a perfect fit for what we're doing.
Yeah, it's a really interesting dynamic. And I think a lot of times people might be inspired by a book or a podcast or something, and then really want to get into the active side of real estate. But I think they should really, think about it deeply, right? Because ultimately it is like running a business, right? That is going to be your business. It's going to be what consumes you. So, do you have, the skills? Does it align with your unique ability? Is it something that you actually love to do and you're really passionate about? And I think you can see that in, top-notch operators, right, who are performing that way. That's, like you said, it's like completely, you get out of bed because you're excited to do this and you really enjoy it. It is a great way for people to also enter the space, right, with some kind of side hustle, or maybe they're doing an Airbnb or some kind of single family to create some alternative income streams. But I always encourage people to think about that, active versus passive. Where do you want to be? Because there's also opportunity cost. If you're starting to manage a couple of rentals, right? But like, let's say you're an anesthesiologist or something, right? And it's totally taking you off of how you could, propel your career, right, on the other side.
I completely agree with everything that you just said. I think you don't always have to grow your wealth actively. There are a lot of opportunities to grow your wealth passively. And I think that, as I mentioned before, the whole reason we invest passively is because we're able to leverage other people's skill sets. So when people think of leverage, they think of it typically in just a financial setting, like when you get a loan to mortgage your primary home purchase, you're thinking of leverage in that capacity. It leverages your buying power to purchase a $300,000 home with a $60,000 deposit. But you can leverage a lot of other components of a business. And one, which I think is most important, is leveraging someone else's skill set and expertise. So I am not an expert in, let's say, for example, the alcohol industry, but I'm invested in a startup rum company. It's called Clear Rum, and they're local to our area. I went to high school with this group of guys, and they are incredible. They're incredible people. I've known them for years. but that's something I would never have gone into, never even thought of going into. But that's just a natural connection that you can tap into if you're open to leverage. So, and leveraging someone else's skill set. So that's something I think that anyone can do in real estate and other asset classes. But really trying to maximize your reach in terms of what you can do to grow your wealth.
Yeah, that's such a great point. And I think it's often underestimated. Since really syndications really came about, investing is a team sport, right? And leveraging those other skill sets is so critical, right? As you put that together. And a lot of, I would say, inexperienced operators or people newer to the game really don't have a full team. But can you talk to us a little bit about, the success that you've had by having kind of a full notch team, right? That including acquisitions and asset management, and how all those components come together to make you a stronger operator.
Yeah. And I think that's been it doesn't happen overnight. So, for anyone who's listening who thinks, you're just starting out and you're wondering how do you grow a team like that, and how does one have such a robust team? That's something I questioned when I first started out, because it's like, which lever do we pull first? Because honestly, we need everyone, and which one is the right person to put in place first. I think when you go to identifying that, the answer lies into who's going to have the biggest impact on the business and carry the next hire. So we like to think of, when we hire, not only do they need to be able to return a profit to the company that covers their salary, but it also covers our next hire. And that puts us in a position to constantly be growing the company. So that's kind of our thought process as to how we go about selecting the position. In terms of selecting the right people and building out the team, it's interesting because we put more emphasis on this test. It's called the Predictive Index, which is a personality test than we do on someone's skill set. So we have an internal barometer after an interview. And it's the first question when we get together and discuss a candidate. We say to ourselves, okay, do they pass the beer test? And that just basically means, would you want to go and grab a beer with this person and be in a social setting? We work in an industry that is not 9 to 5. It is non-traditional hours. It's non-traditional days. And because of that situation, it gets to, you're working with people maybe on a weekend, or you're spending a lot of time with someone. And it's important that we all on some level agree. We don't have to be the same person, but we have to enjoy we don't have to, but we choose to enjoy each other's company. So if you're starting off that way, it's much easier to work with someone that you enjoy working with. So that's number one. The next thing is finding people that already have that expertise that the position needs. So it's not necessarily the skill set of the position as much as it is the underlying characteristics of that position. So I'll give an example. Someone who is an underwriter isn't going to be someone who is a very naturally social person. They're typically people who are more introverted. They're typically people who love working with data and spreadsheets and love sitting in a room and crunching numbers, but they're not typically the same people who would go out and network with brokers or raise capital. So to have someone reach out to you and say, I would love to be your underwriter, and then be very good, socially and in the interview, and also say, I don't like doing the same thing, same task day in and day out. That is naturally not going to be someone who's good at underwriting. That's just been our experience. People who are good underwriters are very precise. They're very, very, very objective. You want them to be very objective. You do not want them to be subjective. You can have someone who, QCs the underwriting and audits the underwriting, who can be subjective. So you have a yin and a yang, but you definitely want someone who is going to follow a set of rules, and errors are at a minimum, right? So that's kind of how, I don't know if you wanted as detailed of an answer as I just provided, but essentially we dissect the role first and figure out what are the characteristics of the role. What is that person's personality trait? And that has more weight than actually identifying, okay, has this person underwritten for the past 25 years? Because if someone has underwritten for 5 years and you're comparing it to someone who else has underwritten for 25 years, but the person at 5 years is a better fit overall, we would go with the person for 5 years. Longevity for us isn't weighted as heavy as all the other characteristics. To us, it's all about the quality of that candidate overall.
Yeah, just so many great points there in terms of building a team. And I mean, it really has a parallel to real estate and building legacy wealth, right? Everything is long term. And it's interesting because I think Wall Street really conditions everyone to think so short term. It's like, things are changing on a weekly, monthly basis. People want to react. And in fact, I mean, that's where most investors lose, right? Because investing is, there's the psychology to it, and it's very emotional, right? So they want to move, right? But when you're investing with a team, right, that's investing, in their business and in those assets for the long term, you as the passive investor get to take advantage of that. And I think that's really massive leverage, and sometimes not fully understood. All of those different roles that you're just talking about that go into, I sourcing, an amazing opportunity, managing that opportunity, giving a great return to investors. All those different components really come together.
I agree. And just to kind of close out the whole thing with interviewing, and it really mirrors closely to investing, to be honest, is when I worked in pharma, I went from working in one department, so to speak, to another department. And in the one department that I worked for, I saw the interview process, and the interview process painted this job as rainbows and sunshine and butterflies and unicorns running through fields kind of thing. It painted this picture. This job was like the dream job. And what would happen is people would come in and they would leave within 2 years max, but typically a year. And then I went to another department and I was in charge of the hiring. And what I did is, it was the same role, but it was different. It was kind of a weird situation. But ultimately, when I would interview people, I would paint the complete opposite. I would literally say, this is going to be the worst job you've ever had. It is extremely difficult. It's a lot of hours. It's a lot of bureaucracy. It's very, very difficult. Only people who are very driven, who are unbothered, and, just let things roll off their back kind of people are people who thrive in this position. And it did one of two things. First of all, it self-selected people who would want to continue on. There were people who literally stopped me in the middle of the interview and said, this isn't the job for me. I didn't think it would be like this. I can't sacrifice weekends. I can't sacrifice evenings. And that was great. It saved me time. It saves, first of all, it saved me time in that moment because we stopped the interview. But number two, it saved me the time because of all that training I would have done with that person after we hired them, right? But then the second thing it did is it actually laid out a expectation for that person, right? And what I have identified, in my life is that when reality doesn't meet expectations, you have discordance. But when reality meets expectations, then you have thriving environments. And that is essentially what happened. So we painted this terrible picture of what the job was. It matched, reality came and it matched their expectation coming into the job. So they stayed. they stayed. And what's interesting is then the other departments were like, well, how are you getting all these people to stay? People don't leave you. Is it just because of you as a manager? And I said, no, it's because of the framework I set up before they even entered the building. And that is the same approach we take with investing. When we have an offering, we don't say, this is going to be the best investment you've ever had. There's no risk associated with it. If anyone has watched any of our presentations, we literally outline not only the risk, which you have to do legally, right? And everyone does that, but we take it one step further, which is we show, a sensitivity analysis to say, if we're off on our operations, if something comes up, or if internally we fail to operate, these are the risks. This is how your returns are impacted. Likewise, if the cap rates change, you also have that risk as well. So we outline those. We're very upfront about it. People ask us what the greatest risk of the investment is specifically. We always identify it. So I think the point is that brutal honesty allows people to make informed decisions, and people feel more confident when they have all the information. They feel that they're more in control of their decisions. And I think that's very important. I think people need to have that information. People can't be painting these pictures that we're just always going to come out of these deals swimmingly, because the point of the matter is that the past 3 years, we have had cap rate compression carry out most people's returns. And that is what has made these incredible deals, these 20 plus IRR returns that everyone is quoting. But when, I gave a speech about this at BiggerPockets, their last conference, I forget the exact numbers, but it was something like, if you had a target 15 IRR and you negatively performed your NOI at negative 8%, which means you underperformed, the cap rate compression we saw still got a 20 plus IRR upon sale. So, and that's if you were projected at 15. So everyone's saying, oh, look at these operators, look how great these operators have been. But out of that audience, there were almost 400 people in that audience. And I asked, of the people in the audience, how many people have invested in the past 3 years, and their deal just sold within the past year, which was about 75% of the audience. And then I said, okay, how many people exceeded original projections? Everyone kept their hands up. And I said, how many people asked for the original pro forma, so the original NOI projections and the original cap rate projections, and compared it to what the actual cap rate was and what the actual NOI was? And only 2 people had their hands up. So people don't ask for those underwriting assumptions and pro forma when everything's going well. They only ask for it when things are going badly, but they're making decisions based on the assumptions that things went well over the past 3 years with that specific operating group, but it wasn't that operating group. It was the market that went well. So they're misattributing that success to the wrong factor. And then what ends up happening, it's like Pavlov's dogs on 2 fronts. You have investors who then continue to invest with a group that essentially failed to perform, right? Because the market carried them out. But then you have operators who were rewarded for never really knowing how to operate. So what are they going to do the next deal? They're not going to learn how to operate because they just were carried out of a deal by not operating. So they're not going to force themselves to change something that they quote unquote think is working. So I think, we're in a situation right now. I know I'm getting totally off topic from what we originally were talking about, but I just, think that investors have to be careful and pick the right operators to invest with, and not just go off of statistics of like these 20 plus IRR returns that happened in the past 2 years without looking into the details.
Yeah, really great insights there, Ashley. I mean, such a good way to look at it. So it's probably a good segue, right, as we're approaching 2023. some major headwinds confronting us in the multifamily space. So how are you positioning, for next year? What are you seeing right now?
So a few things. One is we're still in acquisition mode. That doesn't change. What changes is how we underwrite in terms of being more conservative with interest rates. I think they're cooling off in terms of the Fed hikes, but I wouldn't say that they're done. So just trying to gauge where we think interest rates will be. It changes the loan product. So previously, we were looking at more floating rate debt with rate caps because the interest rates were so low. In this environment, you might even want to go with a fixed interest rate or a bridge, especially if you think interest rates will come back down. Because then you have the opportunity to refinance out without those huge penalties that you would have if you went with like a agency loan, like a Fannie or a Freddie. In terms of one of the things that we've done recently to pivot is we just launched this pref fund. So you can find information about it at thepreffund.com. But the way the pref fund works is we carve out a small portion of the total raise that with a group that we're partnering with, and we come in before common equity. So typically in a capital structure, you have the debt and you have common equity, but we have a sliver that goes before common equity, which means that our investors get paid their returns prior to common equity. So that is during the hold, and then it's also upon sale. So upon sale, the mortgage gets paid off, and then the investors in our pref fund get their basis plus their return prior to common equity even getting their basis back. So it provides a layer of protection. The fund is diversified across assets, operators, and markets. And the whole reason for the creation of this fund is because we kept getting asked what we are investing in personally, Jay and I. And we just thought, we're investing in all of these things, and this is something, we could help our investors by vetting these deals and being involved in these deals. So our investors in the pref fund, it's almost treated like debt in the sense that our investors get paid every single month. It's treated kind of like a coupon, but that allows our investors the assurity of payment, but the downside is they don't partake in the upside. So if you're someone who invests for upside participation, this is probably not the best investment vehicle for you. But if you're looking for more steady, reliable, something that has a very, very low risk to market fluctuations, this is a very good product to look into. So we just believe that this is the way the market presents itself right now. This is a good opportunity for investors to be able to have a low risk, very low risk. In fact, we show the risk profile. Essentially, the deal would have to almost be foreclosed upon for our investors not even to make a return on it. But we also have the ability, if two payments in a row to our investors aren't made, we take full control of the deal. So there's a lot of levels of protection for our investors in this fund. So we just launched it last week, and it has different tranches. So the first tranche is multifamily. There's a multifamily asset in there, but we will be adding self-storage, some more multifamily, probably RV parks, and we're looking into a few other asset classes as well. So it allows you to be diversified across the asset classes too.
Yeah, very interesting. And, I know nothing is a guarantee, but again, kind of moving into 2023, right? It's going to be very interesting, right? And I think this is all about cash flow. Your personal in your fund, personal economy, in your business, right? Do you have enough cash flow if, expenses continue to start going up, right? Whether that's related to supply chain issues that we're having or debt service, right? That continues to go up. So do you see any risk? I know there are some, operators and, potentially pausing distributions, doing some different things to preserve cash flow kind of going into next year.
So we start off with a pretty solid operational reserves, and I think that is quite different than most operators do. So in terms of, I think a lot of operators are freezing returns because operational, they didn't have the operational oversight to have enough reserves to start with. That being said, full disclosure of an investment we have an investment that has a rate cap, so it has a floating interest rate, and we opted at the time for a 1% strike, which means that it's 1% over the interest rate we signed on. So anytime the interest rate goes above that, which it's significantly above that, then we get a refund of that difference. So it's very favorable in terms of the day-to-day, in terms of actively having it. Where it's not favorable, because we got a 3-year term, is the accrual that the lender makes you do for the next rate cap. So even though it's our money going into a fund, it is very significant. So let me put that to numbers. When we first purchased the property, we were accruing $303 a month for the rate cap. The first week of October, I've gotten a couple notices along the way. So for example, in October of 2021, I got a notice that they were increasing it to $1,100 a month. And we started in September of 2020. So September 2020, it was 303. October 2021, they moved it to 1,100. And then in March, they moved it to 9,200. And then the first week of October, I thought 9,200 was crazy. First week of October, they moved it to 54,000. So the way rate caps get evaluated is based off of debt volatility. So when the feds were doing all of their hikes and no one knew where the hikes were going, it builds into the rate cap this volatility risk and this unknown and uncertainty of where the interest rates are going. So to put that in perspective, if we only buy a 1 year as opposed to a 3-year rate cap, 1 year is not going to be less by a third. It's going to be actually less by more than that, because, or a third of it, excuse me, not less than, but a third of that total cost. It would be significantly more. It might even be a fifth of that cost, because to project out the interest rates a year from now versus 3 years from now is obviously a lot easier to do, right? So, well, maybe some could argue it's a crapshoot either way right now. But I guess the point is, traditionally, that is the way the pricing is built in. So in terms of replacing the rate cap, we're accruing right now $54,000, and that's not something we can do long term, even with all the operational reserves we have. So as soon as we got the notice, we put our distributions on hold. And it's not because today we're in a cash strapped position, but if we continue to have to pay $54,000 a month, we would be for a full year. I mean, that's a significant amount of money to be paying into a rate cap, even though we can tap into it when we purchase the next rate cap. So the point is that you do have to be very mindful of your upcoming expenses. I always think it's better to over accrue on your interest or your just operational reserves and hold back. It's an easier conversation to have with your investors, ultimately, to say, I'm holding back more operational reserves just in case they will be paid out if we don't use them, than to have the conversation to say, hey, we're short of money, we need to do a capital call. That is those are your two choices. So really, if you're managing, I have people who are not too happy about the fact that we aren't doing distributions, but it's a responsible thing to do. And I don't make decisions based off of making every single investor in our investments happy about their monthly distributions. What I govern my decisions on is how do I make those investors happy over the lifetime of their investment. So to me, it's a marathon decision versus, a milestone decision.
Yeah, it's that long-term investment view, and again, kind of what I was pointing out earlier is just, it's so hard. I mean, there's so much media out there, right? That's filling everyone's brains with, which is being reactive. I've got to change this, I've got to do that. We get calls from investors all the time, but true legacy wealth. I mean, people are looking 25 years into the future. Right, with investments, right? So that's going to go through several different cycles. And you have to understand that there are cycles, and being prudent with capital preservation is paramount. So, I definitely think that's a wise decision. It does beg the question, however, which is, from a cash flow standpoint, again, trying to insulate yourself, going into a recession, and trying to have alternative streams of income. If the income isn't coming in, right, from these multifamily investments, then, what other options do you really have?
Mm-hmm. Are you asking me personally, or are you asking?
Yeah. Do you have any thoughts? Do you have any thoughts on that from a cash flow perspective?
For passive investors, or for me?
Yeah, passive
investors.
Or
Passive
both.
Investors. I'll start with passive investors. Passive investors, most of our passive investors, at least, they have some other source of income. They have a W-2, so that's their primary source of income, and they're passively investing with us more so for retirement or generational wealth building or college funds, or, something that is outside of their day-to-day necessity fund. So that's a little, I think the answer to that question would be different if those individuals were not in that bucket, where they already have, we only take accredited investors. So right away, they're already making $200,000 as an individual, or $300,000 as a joint filing from a tax perspective, or $1 million or more in net worth. So excluding primary home. So the people who are typically investing with us are pretty set and have some sort of cushion built in. But in terms of how do you prepare for that, I think that's a really good question. I think for someone who is more active and passively investing, getting additional streams of income, for us, for example, we have the fund, and we don't make anything off of the fund. We don't charge. I should say that. Take that back, because we do make money off of the fund, but not in the traditional sense. We don't charge fees for the fund. So the fund actually has to perform for the fund to pay us out. So the investment has to perform. And that is, like a long-term view. But in terms of immediate, we also have a coaching program, and we've put a lot of energy into the coaching program and a lot of resources into the coaching program recently, not just because of an additional resource, but we personally believe it's the best time to get education. Typically right before a recession or in a recession is the best time to be educated on an asset class and be able to take action, because that's right when you're going to have a lot of deals come your way that have a lot of opportunity behind it. So discounted properties, which I think we're going to see a lot of very shortly here. And personally, I think a lot of people are getting out of the game right now. So this is a good time to equip yourself with all of the tools, resources, team, even identifying partners, identifying your market you want to invest in, all of these different things that you can identify now and start to build up a presence and a reputation that position you well to grow during the next recovery cycle. And that way you can ride the waves. So it's really about timing markets. And we're a firm believer that education provides you that opportunity to be able to time the markets better. If you look at really successful investors, like really, really successful investors over a prolonged period of time, it's not because they did the same thing every single day. It's because they did the right thing at the right time. And that's about, adjusting, but not losing focus. So for example, our fund is an example of it. And I'm not trying to do this to toot our own horn here. I'm just trying to, paint the picture of kind of pivoting without really pivoting and going off track, which is we're still in the multifamily sector. We're still within real estate, but we're providing a different investment vehicle, looks a little bit different, but all of the essentials behind it are really strong in terms of our knowledge about multifamily, our knowledge about operations, our ability to identify a way that we can position the equity that's favorable for our investors. So those are little pivots, but it's not, a derailment from what we're doing, and it will be an additional income stream. So there's a way that, you can kind of leverage what you already have as a skill set and kind of think of it in a different capacity to maximize what the market is giving you.
Yeah, 100% agree, Ashley. I think that education, even in a good market, right, is paramount, and that's one of the core pillars and phases to our wealth strategy, is really getting educated, in these different investments, but also in mindset too, right? That's going to be a huge part of the people who come out of this recession and who've actually moved way ahead. The wealth transfer has gone in their favor. A lot of that is mindset, and you can change that, right? You can completely change that.
Yep.
So Ashley, and final thoughts here, if you could give investors just one piece of advice about how they could really move the needle forward and accelerate their wealth trajectory, what would it be?
Take action. People don't take action enough. And if you're constantly moving and looking for ways, even if you've already invested, how do you even leverage a skill set that you already have? I always say that you should lead with value, meaning that you should lead with your skill set that could be opportunistic for a group that's existing. So let's say, for example, that you even have like a marketing firm, or you're good at marketing. You can come into an existing group, and even though you're then going to be considered like an active investor in that group, really you can have your team, like if you own a marketing firm, you can have them take over the marketing and market for that real estate firm, or you could do it yourself and then get some sort of equity ownership in that group. So that's an example. And I just think everyone says multifamily, you're investing in real estate, but I think you're investing in a business. You're buying businesses. You're buying businesses that you have to identify how to optimally run them. And the great thing about businesses is that every single person has a skill set that can contribute to making that business run better. So whether you're a CPA, a lawyer, marketing, accounting, ops, construction, you name it, you name it. If you're in retail or you're in sales, every single aspect that we know of in life is built into these businesses. So leverage what you're really good at. You don't have to be knowledgeable about real estate to come in and partner with someone who already is knowledgeable about the real estate or the investing side of things. So that's what I always say, because too many times people just come to me, and I'm sure they come to you as well, and they come to all of us saying, how do I get in? How do I work with you? How can you help me? And it's like, you know what? If you had just spent that effort saying to me, this is what I'm really good at, I would have said either that's a deficit in my mind, how do we figure out how to work together? Or it would have said, oh, I know so-and-so needs this help. Maybe you can you can partner with them or reach out to them. So that is what I think is the best way to do that.
Awesome. Great thoughts. Really appreciate you coming in on the show today, Ashley. I know everyone's going to really enjoy this discussion. If people want to connect with you or learn more about the fund or Bar Down and everything, what's the best place?
Yes. So if you're interested in learning more about our company, it's bardowninvestments.com. And from there, you can learn about the fund, or you can go directly to the fund, which is thepreffund.com. Also, if you're interested in coaching, our coaching program is Apartment Addicts. So you can find out more at apartmentaddicts.com.
Awesome. Thanks so much, Ashley.
Thank you so much.